Welcome to Subramani. A lot of my friends, rich and richer friends, invest in private equity and private debt. So I thought I'll do a small session on the risks in private equity. Right, so whether private equity or private debt, it doesn't really matter. It is like unit linked. Once you put in the money, you just chuck. You can't come out. The coming out penalties are so high that you won't even think of coming out. And sometimes when they ask you to come out, you do not know whether they're asking you to come out because they've got a better deal. Like if you put in money at 10 plus 90, and they've got somebody else coming and putting in money at 10 plus 290, so they want to take back your shares at 10 plus 110 or 120 and then sell it somewhere. So that inherent opacity, illiquidity, valuation uncertainty, guessing, incentive misalignment, complete misalignment, right? So these are all some of the systemic risk that you see from massive capital inflow into private equity. And this massive capital inflow is happening not because people are putting single checks of 5 crores, but simply because the private guys call you and they wine you, dine you, and take checks of 50 lakhs. So the smaller investors, I mean, it's not really small, but a guy who can put 50 lakhs in one check is now also the target. Earlier, the target was only the guy who's able to put 5 crores. Now it is also the guy who can put 50 lakhs who is the target. So let us look at some of the reasons why this is happening. So first, the biggest worry is the flawed narrative saying, sir, in public equity you can't get a mutual fund. SIP will get you 7%, 10% kind of a thing. Market has already run up, so the best deals are today available in the private equity, which is easy to convince because, oh sir, they're working on cutting edge technology, they're working on AI, they're working on things like that, of which none of my friends understand a rat shit, right? So they don't understand, but they can't even admit that they don't understand because they've spent 30 years in technology or 25 years in banking or stuff like that. So they can't understand that this is a flawed narrative, that private assets will deliver better results. One friend of mine was put into seven private investments. Only one has outperformed the index, and that too has underperformed some of the better managed mutual funds. So if you can't outperform a easily available, permanently liquid, over scrutinized, regulated by SEBI fund, why would you take this risk? But then this flawed narrative that private equity gets you better return than public equity, that's a widespread belief, and I think it's a flawed narrative. Second, indiscriminate capital inflows. People have made money. There's no doubt. People with ESOP who never thought in their life that their net worth will increase beyond 5 crores have today a net worth of 25 crores. So the typical argument is, how much can I lose if I put 1 crore? You can lose 1 crore, but that I can afford. So anyway, I'm selling my ESOP and putting it there. So that money seems to be some easy money, right? So for these people, it looks like easy money. So indiscriminate capital floods have happened. Trillions of dollars, trillions of rupees have flown into private capital, right? So that is one thing. Then complacent or intermediaries with huge incentive to bring people. If I get 0.5% commission for selling a mutual fund, and if I get 5% commission for selling a private equity, what would I sell, right? So misaligned, totally misaligned incentive for the manufacturer and for the distributor. That is huge, and that is happening, right? So consultants, gatekeepers, or any placement agents, anybody can push this through, right? Chartered accountants, lawyers, anybody pushes this through with a 5% commission. There is enough money to be made across. So I get 5%, so I can always find another chartered accountant, say I'll give you 2.5% and sell it through him. So I mean I can use that gatekeeper. right? So that is happening, and it's not that it can happen, it is happening. I mean, I would think all this is part of aggressive retail marketing. Aggressive retail marketing of private equity is happening. The regulator should know about it. I don't know whether the regulator knows but does not know, right? So institutions at least have some method of deciding how to put, but here it is just that look, he fed me in a five-star hotel kind of stuff. So people are putting, aggressive marketing is happening. Very, very questionable valuation practices. So the fees could be very high. It could be 1.75% or 2%. You put in 150 crores or 50 lakhs or whatever, and suddenly they tell you, sir, the value that fund that you have put is now worth so much. So 20% appreciation has already happened. Very good. So they start getting that 1.5% or 2% on 125. You put in at 100, now it's available at 125. This makes everybody happy, right? So everybody is saying, wow, that's great, valuation has gone up, next round of funding, if it happens, will happen above 125. Right now it is unrealized gain. Now on unrealized gain also, the everybody around is getting some incentive, which is again fantastic. May not be the guy who brought in the money, because there may be nothing called a trail commission, but well, the persons managing the money, definitely they get it. Now they could be competent, incompetent, or in compliance with in complicity with the company in which they have invested, so they could be making secret profits. Again, it is too opaque, you will never know what is happening. So overall lack of transparency is a big, for me, that's a big red flag. I would never go somewhere close to it, right? And then what will next happen is sudden narrative shifts or excessive media scrutiny. Every month you have to deliver some news item or something, otherwise you're going to call up and ask that I put money in that education. In what happened? Why are they? Why is there nothing? Why are they not talking about anything? Right? So everybody wants some news. So the whether the promoter goes abroad to get money, or whether he goes abroad and signs some deal with somebody or some university, all that has to be constantly put, so that how else can you tackle the growing media, right? So high profile defaults and credit happen, and then suddenly you realize somewhere your money is stuck or gone or whatever. So let us look at the private equity specific red flags, right? So we saw total red flags, then equity specific unrealistic projections, right? Based on what has happened in the past, the company is growing at 30%, then they say now it will sustain 30% for the next 5 years. It doesn't happen, right? You can't run that fast for another 5 years. May happen, may not happen. So unrealistic projection, typical hockey stick, it did this like this, and then it's going up like this. Doesn't happen. It's like I've done stories on this. Suddenly the trees will kiss the sky. Or I've done one more thing, saying my father hit a snake which was 16 feet long. It was a 4 feet 4 feet snake, which kept getting exaggerated. So these are exaggerated claims, may or may not happen. Inexperienced or conflicted management team. I've seen this happen in one case where the married CEO was having an affair with the CIO, and they fell out, and she went and blocked some of the technology and all that. It was a big mess. So when there is no regulation on all this, and all this can't be regulated, there is inexperience, there is conflicted management, and track record of one-off wins is shown as a regular win, right? So that is just luck, not skill. Markup in games in secondaries and continuation funds, right? So when typically unrealized gains, funds buy discounted LP stakes from immediately mark them up to par or higher, and things like that. So then carry on fees for unrealized gains. Managers take performance fees before cash is returned. Now this is ridiculous, because if your money is stuck there for 7 years, so should be their fees. That is, I am very particular that the fees can be accrued, but the fees cannot be taken. Fees has to be taken only from the money which is going to come back to you. If you have been told that you have put 50 lakhs and you will take 2 crores after 7 years, that's fantastic. But any fees above this 50 lakh should come out of the 2 crores. Cannot come on a annual basis. And there are some people who expect to pay on annual basis, right? Lot of companies are stuck without having an exit path, and the exit path could get very crowded at a certain stage. Right now, the Indian retail investor is putting enough money into SIPs for mutual funds, etc., to give these guys a bailout, but I don't know how long that will continue. Right now, there is a backlog. Industry inexperience, misaligned vision of both the person who's running the business and the person who's managing your money. That's a big thing. Then excessive leverage, frenzy without operational details, right? So there is the commitment by the guys who are managing your money is very little, right? So they themselves don't have much money committed into it. What are the red flags as far as private debt is concerned? Or maybe I'll do it separately. Thank you.